Hi, welcome back to the channel. Now, before I walk through all of the key charts and data, as well as a high-level broader market analysis, it has been an incredibly choppy last few weeks since our last video with the September seasonality that I highlighted last month playing out pretty much to a T. It probably feels like treading water a little bit unless you have pivoted into the value areas. We can add in the continued rotation into the energy space. So it has been quite frustrating for a lot of growth and tech orientated investors. Now, I highlighted last month about Michael Burry and his gigantic bearish bet in August. Now that looks to have played out after September's declines. So congratulations to Michael Burry. But the focus for me now turns to the final quarter and what comes next in the market. Hopefully my work last month, as well as my work across Twitter, have served you well and kept you on the right path. But like I said, I don't want to dwell on the past this month. There is strong seasonal tendencies, but as always, I'm sure there's probably going to be some fireworks along the way, and hopefully there's nothing lurking under the floorboards in October. This month I'm going to walk through all of the updates to the major indexes, give a lot of clear context around the charts. I also have around 15 individual names that you can add to your watch lists for the next few weeks, and as always I hope you find a lot of value from my work, and hopefully the Scottish accent isn't too difficult to understand. The big question I think everybody has, and just from the emails and messages that I get, is the recent correction that we've had in September as bad as it gets. On one side, we've still got the perma bears screaming that it's 1929 and 2007 all over again. And on the other side, we have the perma bulls screaming to buy every dip. As most of you know, I'm neither a perma bull or a perma bear. I'm open to all outcomes. I analyse the data as it comes in, but managing risk is always priority number one. Now, investor sentiment is showing that there is some fear out there. A couple of days ago, we did touch on extreme fear. So there is a lot of negative sentiment. So there is a lot to get into this month. Now, before I get into the charts, for disclosure, myself or my clients may already hold some positions in some of the names mentioned. I have highlighted those disclosures on the charts. If you're new to the channel, I like to use a combination of technicals and fundamentals. I'm told that I'm very good at removing a lot of confirmation biases from my charts, and as most of you know by now, I don't use the magical hindsight indicator. I timestamp absolutely everything, which is massively important for the field in which I work. I'm not a short-term day trader looking for tiny 20-cent moves. I'm looking for structural trends in the market that will last weeks to months. I use systematic process and logical targets, but my work is generally for everyone. I think everyday investors, traders, options folks, financial advisors, money managers, but it's not designed for buy and hold investing, unfortunately, unless you're using price charts to scale into the names that you like. Now, I am told that my work is among the cleanest in the business. It's very well known in the professional world for my ability to highlight the big risk on, risk off turning points at the right time, which, as I'm sure you can appreciate, there's a lot of focus on my work at this particular moment in time. But like I said, my work is all time-stamped. I'm not one of those analysts that makes broad market calls before they play out 6, 12, 24 months later. Very few go on the record with their work. I'm one of them. Some of our big time-stamped calls, I think as most of you will know by now, called the market crash. A year ago, I covered every single major turning point in the market last year, including the bear market rally last June, the rally top in August, the massive market bottom call that I made in October, the rotation back into technology this year, and we could go all the way back to the crash of 2020 as well. I only use my own charts and data, and I do have a track record of being mostly correct, which obviously helps. So if you do find some value from my work, please do hit like, share and subscribe on YouTube, and feel free to subscribe and share on Twitter as well. But please do pause the video, make sure you're comfortable with that very important disclaimer before we kick on. Now, if you do need technical analysis software, we have recently partnered with TradingView. They provide a very generous free 30-day trial. They're absolutely perfect for everyday investors using technical analysis, as well as being incredibly cost effective. I only partner with the best companies, and TradingView are one of them. There's a link in the description for that. But to be clear, this is not for access to our client work. This is purely for technical analysis software. And like I said, there is a link in the description. So enough rambling on. I think the best thing to do is just get into these charts. Now, normally what I would do is kick off with the S&P 500, but what I want to do, as I like to do at the start of every month, is just quickly touch on the yield curve. Now, we already know that the yield curve is massively inverted, and I think what a lot of economics folks are looking at with the charts is really to get ahead of any major corrective phase in the market. And in order to do that by using the yield curve, we know that when we start to come out of a negative yield curve and we start to turn positive, that's generally the danger sign for the equities market. So whilst the yield curve is inverted, I absolutely accept that it's a negative, and we can anticipate that something is on the horizon. We could currently be in that at the moment. I will get into that with the charts that I'm going to walk through. But something that I have highlighted over the last 6 months is real GDP. And if you are new to the channel, what I just want to highlight is last year we actually had 2 consecutive quarters of negative GDP. So my whole focus over the last year has been on the working to the assumption that we are already in a recession, because the textbooks tell us that 2 negative quarters of GDP equals a recession. Now, for whatever reason, the goalposts shifted last year, and there's been a lot of shenanigans at play. We just need to have a look at the revised job numbers that I think we're all probably aware of by now. There's a lot of nonsense going on, a lot of shenanigans, as I said. So if I cannot trust any economic data, that only leaves the charts for the stock market, and that's really where the bulk of my work is obviously focused. I think most of you know that. So if we have a look at the S&P 500, and I'm just using the SPY ETF, which I think most of us are probably used to, we've obviously had a big decline throughout September. Seasonality has played out a little bit. But I'm using Fibonacci levels here at the moment, just purely from a risk management perspective. The percentage of stocks trading above their 200-day simple moving average took a massive decline last month, and we are currently around 40% of stocks trading above that level. Now, that's not indicative of a healthy market. I think common sense probably tells us that. But what I am very, very good at is identifying when stocks and areas of the market and the market in general is a lot more bullish than folks think it is. And I think one of the big concepts that I work with is the failed breakdown. So I think if we get a failed move here and we reclaim the 433 level, which the market has told us today, that the market has just closed on Friday here, and the market is telling us that this 433 level is important. So I think at the moment it's obviously quite negative that we've retested this level and price has rejected. But if we reclaim this level, if you're not familiar with the concept of the failed move with a fast move going in the opposite direction, it's really just a bear trap. I think most of you will probably know it as. So I'm very much looking at these levels here for the start of October to see whether or not we can get back up above these levels. We can look at seasonality as a little bit of a clue. Now, we can see that with September, we're down around nearly 5% on the month for the S&P 500. So seasonality has been pretty poor this year. But we are coming into a seasonally strong period of the year. So very much open to all outcomes here. The charts at the moment are flashing a lot of conflicting information. We just need to have a look at the volatility index. Now, I have color coded this for this month's analysis just to highlight how I view volatility. If we are in an environment where the VIX is sub 20, this is generally what I would consider to be a healthy, normal pullback. The problem then starts to become when we get the VIX spiking and we move into the 20s and then above 25. And of course, the Armageddon headlines that you'll get when the VIX is in excess of 30. You'll see it on CNBC, the headlines, markets in turmoil, which, if you're not familiar with it, is a very, very good contrarian signal to start buying stocks. So when we're sub 20, I'm still very much looking at stocks to buy. That will become apparent in a few minutes when I get into the individual stocks. There's a lot of incredible uptrends out there, but it's just not in the growthy tech areas of the market. Now, the key to absolutely everything for me at the moment is still the US dollar index. I have been banging the drum on this chart for the best part of 18 months. If you picked up our analysis in July, just highlighting the failed move and the likelihood of stocks coming under pressure, broadly speaking, in that environment. So what I'm looking at here is, will this level here at 105 hold, or will we get another failed move? The reason the US dollar index is so important is because of the inverse correlation with the S&P 500. As we can see, as the S&P 500 goes up, the US dollar index is going down, and as the US dollar index is going up, the S&P 500 is going down. So the US dollar is driving absolutely everything for me at the moment. I'm sure it's not escaped everybody's attention that there has been a massive rotation out of the growth tech areas of the market. I think this is really down to what we're seeing with the 10-year Treasury note yield, with TNX continuing to move higher. So I think for me, and the way that I'm approaching the markets at the moment, and certainly what I'm communicating to our clients at the moment, is in order for there to be any kind of meaningful move in the tech space and the growthier areas of the market, and for us to start to look at the discounts in those areas, you want to see the 10-year Treasury note yield roll over here. The bond market is getting massive attention at the moment. We can see, obviously, with TLT now, I'm sure that this is probably the vehicle of choice for many of us if you want to express either a bullish or a bearish position in the bond market. A couple of months ago, I had so many emails calling me a fool because I laid out a chart that said that the bond market in TLT in particular, the $81 was on the table. Now, that thesis doesn't look so silly anymore. We are testing this level at 88. So if we find the 10-year note rolls over at these levels, which is what I would like to see, then that will, of course, lead us to a potential tradable bottom in the bond market in TLT. So this is these are a couple of charts that I'm watching with a lot of interest going into October. But I think most of you are maybe looking at technology and the discounts and the dips in areas that are aligned with triple Qs. Now, some of you might not be aware, but the triple Qs are not exclusively technology. I think the percentage weightings, I think it's about 57% technology, maybe 43% of everything else. So whilst the triple Qs is range bound, this is how I'm viewing the chart at the moment. Solid uptrend, sideways consolidation for the last couple of months. In order for there to be any significant moves in the triple Qs, we need to see this 355 level, I think, hold. This is a pivot level dating back to last month. So provided the October starts off pretty well, that there may be some areas within technology that offer opportunity. I do have a couple of charts that I will present in a few moments. XLK is hanging in there. It's holding above that 164 level. As most of you know, I've been covering this chart for the last few months, just highlighting how range bound it is. With range bound charts, you do not need to overcomplicate it. It's buy low, sell high. Doesn't mean that you need to go and buy the individual tech names. You can express a bullish thesis using the ETFs. But for me, like I said, going into October, I want to see this level here at 164 hold, and just simply buy low, sell high. That's always the dream with any investment. I'm also looking at the equally weighted technology ETF, RSPT. Again, same story here. We just want to see these levels around 27.50, 28 hold. And again, you just want to see the chart start to move from the bottom to the top. Now, what I will say is, I think, like I said before, I'm not a perma bull or a perma bear. There has to be a big focus on risk management at the moment. It's very, very difficult to build a comprehensive thesis with absolute certainty at the moment. As you can see that there's some charts that are saying bearish, some charts that are leaning bullish. When you weigh up all of the evidence, you can't conclusively state bullish or bearish. So it really comes down to just treating each chart on its individual merits. If you look at the Dow Jones, for example, there's absolutely no information that we can take from this particular chart. We've run into overhead resistance, we've pulled back over the last couple of months with the rest of the market. So there's no clues that we can take from the Dow. There's no clues that we can take from the NYSE composite. We are below 16,000 after putting in the failed move a couple of months ago. We've got the All Country World Index, again, massive head and shoulders pattern. This is a chart pattern that we're seeing across a lot of areas of the market at the moment. Given the strong correlation with the S&P 500 and the All Country World Index, we absolutely want to see a potential failed move in these charts. It's obviously encouraging that we've had a little bit of a relief rally in the last few days. Friday, the market's just closed slightly down. It was up a bit, it was down a bit, it was up a bit again, it closed slightly down. I don't have any major concerns on Friday's action, but what I do want to see is these oversold conditions lead to something more meaningful on an individual stock by stock basis. My chart for the Russell 2000, which I've been covering on Twitter, again, found support at logical support levels. So I am hoping for some kind of relief rally, but just for complete disclosure, I'm neither aggressively long or aggressively short at the moment. My message to our clients, etc., over the last few weeks is, look, there's some bullish charts here, there's some bearish charts here. If you want to bet against this chart, go ahead. There's plenty of bearish charts out there, but there are also plenty of bullish charts. But something I did cover last month, and thank you to those of you that reached out via email. I know many of you have done pretty well on the rotation into the energy space, especially into the oil markets, but it's really the same message. If you're not familiar with what a relative rotation graph is, I'll just quickly walk through it. The center point of the chart is benchmarked against the S&P 500. We have four quadrants. We have the weakening quadrant, we have the lagging quadrant, we have the improving quadrant, and we've got the leading quadrant. And the theory behind the rotation graph is, I'm sure most of you can guess, is everything just goes round in circles. Now, it doesn't oftentimes work like that on a day-to-day basis, but the longer term structural weekly trends have continued to rotate into the leading sectors. So from a bullish perspective throughout September, this is where the bulk of my work has been focused. Now, I know that many of you would like me to update and put out YouTube videos every week. Unfortunately, I don't have the time. I wish I could, but this is really the nuts and bolts of where everything's going. We've got the oil markets, the energy markets, the commodity markets, and we're seeing a rotation out of technology. Now, that's not to say that there can't be a rotation into technology soon. I do have some tech charts, but the oil markets are now starting to push up against overhead resistance. Now, one of the things that I would say about the oil markets is, especially within the professional world, and certainly the professional technical analysis game that obviously I'm involved with, and I do notice a lot of overly bullish energy sentiment. And for me, as someone who has been advocating being long energy since May, I do start to worry when I see a lot of the technical analysts and a lot of the CMTs, etc., start to put out the bullish charts based on relative strength. For me, it's starting to get late to the party a little bit, and like I said, a lot of the bulk of my work is focused on finding trends in the leaders before they become leaders. So for me, a lot of upside objectives have started to be met within the energy space. Gold, again, still needs to get above that 2100 level if you are looking for that move into commodities. The commodity space is very, very front and centre for me at the moment. I think it's gearing up for a potential breakout above 110 in the Bloomberg Commodity Index. So that's really the broader market work that I'm focused on at the moment. Now, before I get into around 15 individual names that I think you can add to your watch lists, please do hit the like button, share, subscribe. It all helps to get my work a lot more noticed and out there. So again, like I said, hit the like button, be much appreciated. But let's just quickly touch on some of the big technology charts and some of the names that are trending higher. Semiconductors get a lot of publicity and a lot of headlines. For me, it's very, very logical. They stopped going up a couple of months ago at all-time highs. There's nothing surprising about this one whatsoever. But what I am looking at are charts like Nvidia, and obviously I look at dips as opportunity, but I like to use technical analysis to find optimal buy points. Again, you could wait for a breakout above 500 here, but for me, I'm actually looking at this as a potential support level here. Now, this is obviously a longer term chart dating back to 2018, but these pivot levels here around 400 might offer opportunity with range bound charts. Like I said a few minutes ago, you buy low, sell high. So I'm actually watching Nvidia really, really closely. We've got AMD finding support at its 200-day simple moving average this week. For disclosure, I put this chart to our subscribers yesterday, just highlighting this, and again, we'll see what happens with it. We've got Tesla, again for disclosure. I own Tesla. It's been a recent recommendation. It's found support at its 100-day simple moving average. So I am still working with upside objectives highlighted here despite the recent pullback. We've got Apple. again pulling back to its 200-day simple moving average. The reason I like these pullbacks to the moving average is it's not because it offers a definitive certainty that the stock is going to rebound. The reason I like pullbacks to these moving averages is it allows you to define the risk really easy. There's obviously a really good risk to reward proposition being offered. You don't need to overcomplicate it. For me, it's very straightforward. Bullish above the 200-day simple moving average, not so bullish below it. But at the end of the day, stocks like Apple, Tesla are stocks that I think most are quite happy to dollar cost average on, etc. But for me, if I'm looking for a new position, I just like to use very basic tools. It could be moving averages, it could be Fibonacci levels. Each chart is completely different. We've got MasterCard again continuing to hold up above that 395 400 level. Yes, that the pullback over the last few weeks hasn't been pretty, but again, if these levels hold up, then these are prime buy the dip candidates. I think the problem is, of course, if the market continues to fall off a cliff next week, then you really have to manage risk in that environment. But these are all charts that I'm quite comfortable with. I'm looking at Netflix this weekend, again pulling back to its 200-day simple moving average after a big decline. We've got I've been covering this one on Twitter for feels like forever. We've recently just met our upside target here for CCJ. The target was around 43.44. We got around 42.50, I think, in the end. It's pulled back today around 3-4%, which is no real surprise. But for those of you that keep asking me on Twitter, that's the chart. It's the target is now met. New all-time highs for CBOE. Again, another disclosure, but again, I'm not discriminating against uptrends. I don't pigeonhole myself as a tech investor or anything. I simply just go where the trends are. CBOE, we've been covering this one for a couple of months now. Same with Consol Energy. It's moved 35%, but we have now closed above the psychological $100 level. So again, you keep it really simple here. Bullish above 100. If it dips below 100, maybe not so bullish anymore. Same with CLS. Now, I've been covering this chart on the YouTube channel for a couple of months now. Still get asked about it a lot, so here it is. The trend is still intact. If you're holding this one, massive congratulations. You've been rewarded. I think it's up around 60% now. So again, this is where systematic process comes into play. You just hold it until the chart tells you to sell it. INTU, again, it covered this one last month. It did break out above that $500 level. It has pulled back, but it is still continuing to hold above 500. KWeb, Chinese internet names, a lot of volatility attached to them, but the chart for me is looking a bit head and shoulders-y. So I think if we do start to break down below those levels around 26.50, then that's a potential problem and a headache for anyone that's investing in China. AMR, again, I've been covering this one on Twitter for quite some time. Again, systematic process. We've been covering this one so long now. New all-time highs this week. The trailing stop now is up at 239. HRB, again, another disclosure. We have met upside target number 2 now, which is up at $44. So for those of you that may be looking at the overbought conditions in the market here, you might want to consider profits. Who knows? And VLO, Valero Energy, is also potentially quite close there. So that's the analysis. If you found value from that, like I said, please do hit the like, share and subscribe button. But please do jump on to our website at honeystocks.com. We are doing a big autumn offer at the moment, which offers 20% off all of our subscriptions. But just to quickly show you what our memberships provide, we provide access to all of our premium weekend analysis, all of our high conviction investment ideas. We provide access to our midweek halftime analysis. We also provide access to a wonderful community, all of our chart books, and if you are somebody that's learning a bit more about technical analysis, we also provide access to our complete technical analysis program. But just to quickly show you what our ideas look like, this is an idea for CCJ that's done really, really well. Tesla has been massive on 2 occasions this year. Meta, we've got DraftKings, massive winner. JP Morgan, good winner. Amazon, massive winner. Apple, big move as well. So I'm very unique in what I do. I log for transparency all of our high conviction ideas. So please do jump onto our website and scrutinize that. There's not any penny stocks or anything like that. But I think if you're somebody who has a mid-term approach, you're maybe looking to get away from day trading, maybe learn a bit more about technical analysis and systematic process, etc. Maybe you just want to be part of a community because you're sick of hunting around social media, you might find a home. So please do jump onto our website and check it out. But if you've stuck to the end, thank you very much for watching and have a wonderful weekend. Thanks as always.